Hi there, welcome to the latest video. It's going to be a short one, but it's entitled Diversification versus Conviction. How many stocks should you have in your portfolio? I looked at that at a little spreadsheet, which may help you. It helped me anyway. By all means, if you like this video and you want the next one to your inbox, hit that subscribe button and the notification bell. Okay, let's get into it. So the question is diversification or conviction, all right? How many stocks should your portfolio hold? This is what Warren Buffett said. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. And pretty much, it's true, you know? If you hold more than 20 stocks in your portfolio, you might as well buy a fund instead. It's more cost effective, and let's be honest, the gain you're going to get from 20 funds, 20 stocks or more, is pretty much the same as a fund. You are the market, pretty much. You're going to perform as well as the market, all right? And just to point out, you know, the bigger risk, the bigger the reward. The smaller the risk, the smaller the reward. But what you're aiming for is this kind of scenario, where you can get big reward but lower risk. You know, so you can go for big risk and small reward. There's no point doing that. And people do, and it's, you know, it will help you immeasurably if you can work out the risk and reward of a stock. There's a big upside, but there are certain times when the risks are lower. For example, small cap stocks, if they've just raised a bit of money, after they raised money and they've got some milestones and some value, you know, generational milestones coming up, then that's the time to invest after a bit of churn, maybe because of the share prices. So the risk has gone down a little bit there. One of the big risks of small cap stocks, they don't have cash. So that's one kind of risk. But if you want to make money, you don't need more than 10 stocks, okay? You have to have conviction in those stocks. And I've done this little it's a spreadsheet. It'll help you. Okay, so these are a number of holdings across here. Let's say you've got 100 stocks, all right? And let's say one stock moves by 100% down. And this is assuming all your holdings, so if you've got 100 holders, they all take up 1%. Or if you've got 50 holders, all 2%. So they all take, you know, equally weighted, you know? So if you've got 5 holdings, they all take 20%, for example. So this is how to work out, you know, kind of thing. Of course, towards this end, the risk and the reward is greater. This end, the risk is lower and the reward is lower. So, if you've got 100 stocks and one stock bombs, absolutely bombs, just goes bust, delists, you've only lost 1%. All right? So that's okay, isn't it? That's plenty, you know, it's you know, very low risk tolerance there. But if you get a stock that does 10 bagger, does 1,000%, you know, and that's very rare. Stocks don't do 10 baggers very often. I try and chase them all the time, you know. Then your portfolio value will only go up by 10% if you've got 100 stocks. To me, that's not acceptable. If I manage to get a 10 bagger, that's heck of an achievement. I want more return, more reward than that, you know. So let's move along here. So let's say you have 20 stocks, all right, and you know one of your stocks just goes bust, then you lose 5%. It's not bad. But again, if you get a 10 bagger, you only get 50% rise. You know, this portfolio will rise in value by 50%. You're not going to be rich, are you, doing that? And like I said, even if you get a 50% rise in one of the stocks, the entire portfolio will only get by 2.5%. Is that what you want? So this is where I, you know, spend my time pretty much. I don't want to ever go over 10 stocks. Unless I'm really weighted and I'm sort of scaling into certain thing. And I'm edging towards 5 stocks now because I understand if you can work out the kind of risk and you understand the risk, I'm happy with that. You know, take no more. Now, if you got the extreme here, one stock, just, you think you've got the one, you know? Of course, if it goes bust, you've lost 100% of your money. Can you take on that much risk? Do you want that much risk? It's up to you. You don't have to. But if you get a 10 bagger, you get all of it, of course, 1,000%. But of course, even if you go one step down, then one stock goes bust, you lose 50%. But of course, if it's 10 bags, you get 500%. So you've got to look at it, you know, if you want to make money, you can't be really over this side, 150 stocks, you know, 20 stocks. Because even if you get big upside, your portfolio value is not going to, you know, improve that much. You know? So if you go here, for example, we own 10 stocks, let's say 10 stocks, never figure, and one of them goes bust, 10% you've lost. That's, you know, I can cope with that. You know, I can even cope with if I have 5 stocks and one of them goes bust, because it doesn't go bust very often. And if you do enough due diligence, you reduce that chance anyway. So if one did go bust, you lose 20%. But let's say, you know, one drop, it's more likely to happen where a company will have a nightmare and it'll drop by 50%. If you own 5 stocks all equally weighted, they'll only take 10% of your portfolio down. So to me, I'm happy with that risk reward. But of course, if you get a 10 bagger, it'll double, double, treble the size of your portfolio, because that's 200% increase. So if you're, for $5 grand, for example, grand each stock, that'll go up to 15 grand. So that to me is an ideal risk reward here on this level. So it's worth looking at. Like I said there, understanding how many stocks you have and the impact it has on your portfolio if you get a big winner or big loser. I hope that makes sense. But conviction, with me, I can't trade. I'm not a trader, in and out. I have to believe enough in a company to allocate a decent chunk of money to it. That's what I have to do. I don't want to make small technical trades for 10, 20% profit here and there, a couple of £100 here. I want to invest in businesses for big gains between 100,000%. It can be done if you pick the right, companies and you do your research. But you've got to do research. To me, trading is a bit lazy. Look at the charts. You don't have to do any research at all. Just look at the chart. Oh, buying this. Or a bit of sentiment. Go research. A bit of hard work. Do the research, know the risk, and know the reward, and it will help you. This is why I use this filter. Whenever I put companies through this filter, I know where I am on the risk reward. For example, liquid assets. I know whether they've got how much risk they've got, how much cash they've got there. That's a big risk if small stocks haven't got cash. And I also try and see how big they are, how much upside they've got in the reward section here. And of course, I look at every other thing as well. So as long as you do your research, you only reap the reward if you know the risk and you know the reward. Hope that provided you with some value. If it did, then by all means, hit that subscribe button and the notification bell. And I'm going to try and do a shorter video once a week if I can. I know the other videos on companies can be a bit long. So I'm trying to do a shorter video, but I do tend to talk too much. So there we are. If you want to see any more videos I've just done, then by all means, they're on the side there. And if you want to subscribe, then hit my face there. And don't forget that notification bell.